Today we're going to talk about learning to take a profit. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Again, just want to give a shout out to everybody. Thank you for all the feedback, questions, comments. I'm glad that a lot of people are getting benefit out of the videos. The videos, I'm trying to break them down into smaller components each day about the actual things you're going to encounter in live trading time. It's one thing to have a trading plan saying this is where I'm going to enter, this is where I'm going to exit, this is how I'm going to control my risk, this is how I'm going to manage my profit targets, my stop loss, all that. But when traders get into live time, especially when they're day trading, and they are challenged with a lot of the tactics that the smart money will throw at us, the widening of the spreads, the fast moving candles, the holding of price at levels before they shift it, the flashing of the numbers on your platform, freezing of your platform, a multitude of tricks that they have up their sleeves that can cause you to second guess your decision making. They can cause you to pull out of trades that are potentially going to be profitable trades in the right direction, and also affect your confidence in your psyche to be able to be consistent at the screen every single day, which is why the big emphasis on a lot of the material is working on the habits and the skills that you're going to need to cultivate in live time. So it's one thing to have a strategy. We talk about a really simple system using the high and the low of the day, whether that's a redrawn high and a redrawn low or the overall highs and lows of the day. The equity opening times in that 12 candle window, in the majority of cases the market tends to move quite strongly around that 12 candle window, 50 pips or more, and also focusing on managing your risk for asymmetrical profit targets. So obviously risking 1 hour for 3 or 4 or 5 hour, so that if you are stopped out and you take a loss, that is irrelevant when you're having profitable trades that are 2 or 3 or 4 or 5 times the amount that you're losing on each trade. It's critical that you get good at losing, because losing is what ensures that your system stays profitable if you're hitting the trades consistently. And again, we talk about don't focus on trying to scalp pips out of the market. I think long term that's a very challenging endeavor to remain profitable and not to let the market's swings and volatility affect your psyche as well as your financial capital. The purpose of trading off the high and the low is it gives us the opportunity to identify areas in the market where the risk slightly shifts in our favor in terms of positioning ourselves in the market for a move back potentially to the other side or to a recent extreme, again for 3 or 4 or 5 times our risk. And we're trying to piggyback on the smart money, not just jump in and predict where we think it's going. We're letting their price action tell us when they're getting ready to shift and move back in the other direction. One thing one of my mentors taught me years ago, a gentleman named Bill McLaren, he was an options trader in Wall Street for 40 years. He talked about calling up one of his mentors when he was younger working on Wall Street, and he said, "What do you think of my trading results?" And the gentleman had gone through all of his results, and it was an older man, and he was on the phone and he said, "Learn to take a profit." And he hung the phone up. And I didn't really understand that until the last few years, because I've been in several trades where the market has moved strongly in my favor, anywhere from 50 to as much as 700 pips, and I've not taken money off the table. Now that may sound ridiculous, but it's very easy that when you're in live time, and that 700 pip was on an end of day trade, but we call that the around the world trade. When you get into a position, whether you're long or short, you're holding on, it's going to go forever, and you still think it's going to go forever, and it comes back and gets you where you started from, and you get nothing because you want more and you're afraid to let it go. You're afraid that it's just correcting, it's just noise, it's going to resume its original drive, all these crazy things that we talk ourselves into. So today we're going to talk about learning to take a profit. What's really important, especially when you're in the intraday market, if you have been following the currency pairs long enough now, you will realize that nobody gets a free lunch. Almost every single profitable trade, whether it's within the 24-hour cycle or by the end of the week between Monday and Friday, the majority of profitable trades, unless it's in an extended strong trend on the daily chart, which even then they will come back and stop you out, even if it's just at break even. So it's really important that you remember one thing. Another mentor of mine told me you get paid for performance. And there's lots of times in the market where I might have a 50 pip target in the market moves and has cleared out stops but hasn't gotten to my profit target. It's at numbers, and I've held on to that and watched it come back. And in one candle, especially on the pairs that have the wider spreads, you could be up 40 pips, 45 pips, and in one candle, if they reverse that, you could be up 15 pips. So in the matter of 15 minutes, you're now faced with the decision of taking 15 off or getting nothing, or holding on and hoping that it reverses. And that's not a good strategy. Hope is not a good strategy. Which brings me to our second point. Just on this first one, remind yourselves, you're not here for free. It's important that you get paid for your work. Even if you're trading micro lots, treat it with the same respect you would for $1,000 a pip. We talk about identifying a couple of key simple setups, learning how to master those, and learning how to scale them up. When you realize the power of scalability and simplicity and being able to duplicate those strategies day in and day out, you realize that it's important to have a plan to come into the market each and every day based on where that trade may take place for 50 pips, 75 pips, 150 pips, whatever it is. You need to have a plan in place so that when you put your orders into the market, you've got them automatically programmed in there, so that once you're in the trade, you don't start doing little things emotionally, changing your mind because you think now it's going to go, instead of 50, it's going to go 500. You want to hold on for more. Your own emotional bias will confuse you and distract you from staying focused on the process itself, which is to execute your trading plan. Not holding on and not taking anything off and being stopped out with nothing. Not understanding when the move may be exhausted. We talked a bit about this yesterday in the 12 candle, the 3-hour blocks. If you're in a move and it's gone 3 hours and the market's consolidating, if you can't see that the market is potentially reversing or setting up a stop hunt or a trade in the opposite direction, again, you may end up with getting nothing off the table. And then, of course, there's no real understanding possibly of where a reasonable target is. And we're going to talk a bit about that today as well. So one of the things with profit targets is my standard rule of thumb on a normal day is 50 pips. Now recently we've had more volatility in the market, so those have actually doubled out from 50 to 100. Now there are certain setups that it's a 50 pip box because the market may have come down from high to low at some point. It's come down, it's given us a low, it's come back inside, and it's given us a trade short back to the bottom of this range. Now that range may only be 50 pips, and they're coming back to obviously hit stops at the bottom of this market. If a market is going to continue to do a measured move and extend out another extension of that range, the market will not come down here in pushes. It comes down and bursts through that level. It will come back, consolidate, retest that box low, and continue to move on. So I've showed on a couple of videos, and we'll do that again today, I tend to take 2 times the range that I'm trading in. So if this consolidation was a 25 pip box, my profit target would be 50 pips from that low. If it's again a high and a low setup, and the market, if that range is 25 pips, my profit target could be 50, 75, or 100. We'll measure those based on where we're at on the day chart itself. But technically speaking, my minimum profit target is 50 pips. I talk about not getting caught into trades inside of this range if the range is 25 pips. And the reason why is that if you're getting jammed in the middle here and the range is only 25 pips, you can't get to break even, and you can't have much room for profit target either. So typically speaking, if we're in a normal day and we're trading from one side to the other on the British pound crosses, again, I only trade the British pound crosses, my minimum target equals 50 pips. Pound New Zealand, pound Australian, depending on the setup, can be 100 or more. Now again, we've had more volatility recently in this last couple of weeks, so obviously those ranges have ballooned out and the profit targets are bigger, but we still work from the high and the low, and we still work off of round numbers, predominantly double zeros, but also 50s in between. So again, if you're trading from a 50 to the bottom of the range and it's a stop hunt, typically speaking, depending on the timings as well, that'll be a 50 pip target. If we're up high, possibly on a double zero box heading into the high of the New York session for a short, that would be a minimum probably of 100 pips. And in some cases, if they've given us a low of the day down somewhere below that box, we could be extending that out for a 200 pip move or 150 pip target. Those are some situations that when they arise, when you're planning your trade, you may have a strategy for either trailing it once it hits a certain level. If it's gone 50 and it goes through 75, you might adjust your stop. Now, one of the things you need to be aware of if you're trailing a profit target is that if you're in a 50 pip profit target trade and you move your stop to 25 pips halfway when they're in the lower part or upper part of that 50 pip move, in the majority of cases, before they hit that 50 pip extension, they may come back and hit that quarter again. And the reason why that is the algorithms, the institutions, the smart money, they know that traders they follow their profitable trades. In the majority of cases, if you're trailing your stop, they may come back before they hit that 50 pip movement to stop you out at the quarter level. So if you're trailing your stops, these are things that you need to be aware of. Often in a lot of cases, I will not move my stop from break even. I will either have my stop at break even and look to exit a trade if for example, again, we mentioned if my trade profit target was below numbers or below a high or a low, you need to be aware that a trade can fail at any point at a high or a low. This is the most dangerous point for the market to reverse. So really important, these are things that you're going to encounter in live time. And again, it's really important that you get paid for your efforts. You know, if you're taking off a little bit or 25, 50 pips, whatever that is, it's important that you get consistent at that, get consistent with your process. Plan everything out. You can only control two things in trading: how much you make and how much you lose. And when you understand that, you understand the importance of executing your stop loss and keeping it at 1R and keeping your profit targets up at 3 or 4 or 5R so that our positive expectancy is hopefully 2 or 3 above, and then taking a loss is no big deal. So it's critical to be taking a profit. Now, if I don't scale into positions. I will take one position in, one position out. That's just me. I know there are other strategies that I have looked at with adding trades in, and if it's moved a certain distance, going to break even and adding another position in if it's in a larger market move in with a bigger trend. I've learned a lot of stuff from Peter Brandt. If you haven't read Peter Brandt's material, get his books, follow his blog. He's a classical chartist, but one of the great things I've learned from Peter is targeting boxes of consolidations. He's a breakout trader, but those boxes, whether we're selling high, buying low, or buying high for a measured move, these ranges, this geometry, and this is how a lot of the algorithms and institutions work, will do extended movements out of 2 times that range that you're trading in. So often your rectangles, your W's, your M's, whatever you're looking at, those markets will often expand out twice the range that you're trading in. That's my standard rule, which is why if I'm in a 25 pip box, I'm looking at a 50 pip target. If it's a 50 pip box, I'm looking at a 100 pip target. Now sometimes those targets will be bigger because even though we've got the geometry there, we may have highs and lows spread around those areas, and if that's where the money is and I think the market's going to go get the money, I may let it go through a target. I'll be adjusting my position down or up, and then I will look to maybe follow a candle if it's going through in strong bursts to maybe follow the highs of the candles once it's gone beyond my original profit target. These are all strategies that you have to sort of, it's malleable. Taking profits is an art, and that's the thing about trading. Nothing is concrete, but you can control your process, you can control executing everything, and then over time looking at how maybe you could have gotten more out of certain winning trades, squeezed more out of your winning trades. And as we get further along, we'll look at other time frames in terms of how to keep our risk even smaller on some of these A-plus trade setups. So hopefully you got some value out of today's video, traders. We're going to go through some examples on the charts now. Thank you again for all the comments and feedback. Stay disciplined, stay focused, and may the markets go with you.
Okay, traders, let's take a look at some examples of measured moves and taking profit targets, and then also tying that in with numbers. An easy strategy that I will often employ is in this particular situation. We had the pound yen yesterday. We had a big, large pin bar hammer to the low of the day, and then an engulfment pattern that, as you can see, did one full expansion of that range up towards the high of the day. And again, even though we had volatility in that market yesterday, there's a couple scenarios we can paint with taking profits. This is one. Again, these aren't Fibonacci's. This is just 100% expansion of this range. When you get larger brackets like that, it will usually be one full expansion. And then also the other thing to look at is the price boxes that you're trading inside of. So in this particular case, the market, we had a lower rectangle. If we go high to low on the opens and closes of that market, again, we had three full expansions almost, but it ended at double round numbers at 50. But in my standard rule of thumb is on a trade like this is to take the number boxes, and if it's 25 or 50, in this case it was 50, at least one full expansion of that range, or two 50 pip boxes, which would give you a 100 pip target from your entry point. So this bull candle is roughly 25 pips, and the break of that would be a 50 pip target in the inside bar. The previous day, when we had our large M pattern paint on the pound yen, again, traders can see that that's just from numbers to numbers, a 75 pip box, and one full measured move of that would be 75 pips below that range. Now here's an example of where the market didn't quite go to the numbers. And again, this is a scenario that if you're on this trade, trading it down to the numbers, you want to take a look at a couple of things. One is, where is the profitable trade at from to the left? So if they're going down, and they're going to be stop hunting traders that are in the market already, if they've hit that stop, this market potentially may not go all the way to the numbers, which is where we will follow a market down. Obviously, traders, if they're trailing this stop, would have been stopped out somewhere in here. But if you're going down to a smaller time frame, you can use 5-minute chart, whatever, to possibly squeeze more out of this trade, or have the numbers plus a certain distance away from the numbers, especially when the market has already moved over 100 pips. So anytime the market moves more than 1 ADR, you need to be very careful in terms of assessing how far that move will go. But the first thing you want to be looking at is, have they stopped out profitable traders? If they've done so, that move could be exhausting itself. Another example from yesterday is the pound Canadian. And here's an example of a fast moving market on the London Open, where they've spiked the low and then given a short trade later back down. And again, the trade has gone from numbers to stopping out the profitable trader who was long. So as opposed to a measured move, in this particular case, the trade has actually moved 50 pips, but traders who have just shorted the inside bar, they would have been filled roughly around 33, 34, and that market has gone down to as low as 76. So they would have potentially got their 50 pips, but again, once that stop hunt's taken place And if you've been painted a candle that could potentially be a trade in the opposite direction, that's when you definitely either want to be lowering your stop just in case that market does continue below that bull pin hammer. But if it does reverse, you can at least trap maybe 40 pips on that move. Again, at the top of that market, we see the market go to the high in the US Open and then before moving down to the low of the day. Again, this is an example of a measured move, would have given traders at least 50 to 75 pips, but the full range expansion of this trade went from double zeros down to double zeros. So the market has obviously their stops at each of these lows. But again, this is an example of if you had taken a 50 pip target or 75 pip target and the market has consolidated and then moved down, you may want to trail this market down. Again, I usually do use preset profit targets. I like the market to move quickly through a level, take me out of the market. I'm happy to get my 50 pips or 75 pips or 100 pips and call it a day for the session. So standard rule of thumb for me is 2 times the geometry that we're trading in. Again, this is where when you go back and review your trades, you can ask yourself certain trade setups, if they occur at the high and the low of the day at the US Open, after the market has been in the London and the Asia session, you may want to assess as to whether or not you can get more out of those winning trades. If you're trading inside of the range, as we looked at yesterday's trade, these typically, again, when we're inside of a larger range from previous session, that's where I'll look for the market to potentially be hitting stops and reversing or trading off of the high. Another example in the pound Canadian at the US Open on Tuesday night, that market went up. And again, similar to yesterday, moved right through all of the stops to the redrawn low from Monday for a 100 pip move down. So again, taking profits is an art. There is a degree of malleability to it, but again, you have to assess at what point you're taking the trade. Are you taking it from one extreme? Are you taking it from inside? Trades that come from inside typically will be stop hunts to the extreme. Ones that occur at the extreme typically will be the ones that will give you more than 50 pips. Just something to consider. An example of that, even from this morning, we saw the pound yen extend down 150 pips, retest the low, giving us a W formation off of the low, and the measured move on that trade this morning takes us roughly into the ballpark. It's hit 2 times the expansion already, but it could actually go as far as stopping out traders who shorted at the beginning of the day for another leg up. We'll have to watch that and see. So hopefully you got some value out of that, traders. Learn to take a profit. You get paid for performance. Make sure that you're at least going for 2 times what you're risking. Even if you're doing a measured move of a bull candle or bear candle reversal, the market should at least do 2 times a 1 candle distance if it's an engulfment. Just something to consider. So stay disciplined, traders. Stay focused. Get paid for your performance. Learn to get better at taking your profits and squeeze as much out of your winners as you can. Have a great trading day, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.